California has long been recognized for having some of the most expensive housing in the nation, but recent data from the California Association of Realtors reveals that the affordability crisis has reached a concerning new threshold. According to their 2026 housing market forecast, only 18% of California households can now afford to purchase a median-priced home in the state. To put that in perspective, less than 1 in 5 California families has the financial capacity to buy a typical home. This represents a modest improvement from 17% in 2025 and 16% in 2024, but it remains near historic lows for housing accessibility in the state. The median home price in California is forecast to reach $905,000 in 2026, according to CAR Senior Vice President and Chief Economist Jordan Levine. This would represent a 3.6% increase from 2025's projected median of $8,739. While the rate of price growth has moderated compared to previous years, the absolute dollar amounts continue moving further away from what typical California families can afford. Understanding housing affordability requires examining multiple economic factors simultaneously. According to the California Legislative Analyst's Office, monthly payments for newly purchased homes are approximately $2,400 higher than they were just a few years ago. This increase stems from two primary sources. First, home prices rose substantially between 2020 and 2022. During that period, strong demand and limited inventory pushed California home values to unprecedented levels. Those elevated prices established a new baseline that persists today. Second, mortgage interest rates increased dramatically beginning in 2022 as the Federal Reserve raised rates to address inflation concerns. According to the LAO's Housing Affordability Tracker, prevailing mortgage rates on 30-year fixed loans climbed from 2.7% in January 2021 to 7.6% by October 2023. The CR forecast projects that average 30-year fixed mortgage rates will decline to 6.0% in 2026, down from 6.6% in 2025. While this represents improvement, these rates remain substantially higher than the levels observed in the years immediately prior to the pandemic. For comparison, the long-term historical average mortgage rate over the past 50 years approaches 8%, providing some context for current conditions. When both home prices and interest rates increase simultaneously, there is a compounding effect on monthly housing payments. Buyers must pay higher interest costs on larger loan amounts, creating affordability challenges that extend beyond what either factor would create independently. The rapid increase in mortgage rates has created an unusual dynamic in California's housing market. According to the Legislative Analyst's Office, approximately 80% of California homeowners currently have mortgage rates below 5%, compared to current rates around 6.25%. These homeowners face a significant financial disincentive to sell their current homes and purchase new ones. The LAO provides a specific example to illustrate this challenge. If a homeowner with a 5% mortgage rate sold their home and purchased a similarly priced property at current interest rates, their monthly payments would increase by approximately 11%. Over the life of a typical 30-year loan, this would amount to more than $95,000 in additional payments. As a result, many existing homeowners are choosing to remain in their current properties, even when they might otherwise prefer to move. This behavior pattern further limits the number of homes available for sale in a market that already faces significant inventory constraints. The phenomenon affects housing supply dynamics in ways that compound affordability challenges for prospective buyers. When existing homeowners don't list their properties, first-time buyers and families seeking to upgrade face even more limited options and increased competition for available homes. Housing affordability challenges in California vary significantly by region and property type. According to data compiled by the Legislative Analyst's Office, California home prices have long exceeded national averages, but the gap has widened in specific market segments. Mid-tier California homes, which represent properties in the 35th to 65th percentile price range, currently cost more than twice as much as comparable mid-tier homes in the rest of the United States. This differential reflects both California's strong economy and long-standing constraints on housing supply. The affordability challenge becomes even more pronounced for first-time buyers seeking entry into homeownership. Bottom-tier homes in California now cost approximately 30% more than mid-tier homes in other parts of the country. This gap has widened over the past decade, though it narrowed slightly in the most recent year of data. These regional disparities create particular challenges for younger Californians and families attempting to establish themselves in the state's housing market. The price differential between California and other states has led some economists to examine whether California faces unique structural barriers to housing affordability beyond typical market dynamics. The LAO's housing tracker also examines the financial comparison between renting and purchasing residential properties in California. According to their analysis, monthly payments required to purchase a two-bedroom home currently exceed the cost of renting a similar property by approximately $2,010, representing a 62% premium. This substantial gap reflects several factors. While rental prices have increased significantly in recent years, the rate of increase has not matched the combined effect of rising home prices and higher mortgage interest rates on monthly ownership costs. For many California households, this financial reality means that renting remains the only feasible option, even when they might prefer the stability and equity-building potential of homeownership. Economic analysts note that this dynamic has implications for wealth accumulation patterns, as homeownership has historically been a primary vehicle for building household wealth in the United States. The rent versus buy calculation varies by specific location and individual circumstances, but the overall pattern suggests that California's housing affordability challenges extend across both rental and ownership markets, with ownership becoming increasingly difficult for middle-income households. A fundamental aspect of the affordability crisis concerns the relationship between housing costs and household income growth. The Legislative Analyst's Office notes that costs of buying a home have grown significantly faster than median household incomes in California. This divergence means that even as California households see wage increases, housing is consuming a larger percentage of their monthly budgets. The traditional benchmark for housing affordability, established by the U.S. Department of Housing and Urban Development, suggests that households should spend no more than 30% of their income on housing costs. According to the National Low-Income Housing Coalition, the fair market rent for a two-bedroom apartment in California was $2,030 in 2021. To afford this level of rent while staying within the 30% guideline requires a household income of approximately $8,191 annually. Renters currently need to earn nearly 3 times the state minimum wage to afford average asking rents in California. CAR President Heather Ozur, a Palm Springs realtor, acknowledges these challenges while noting some potential improvements. Home prices in California are expected to rise in 2026, but the growth pace will remain mild when compared to rates we've seen in past years, Ozur stated. For would-be buyers who sat out the competitive market during the past couple of years, that means more opportunities as inventory increases moderately and lending conditions become more favorable. The housing affordability situation exists within a broader economic context that affects Californians' capacity to purchase homes. According to the CAR forecast, California's non-farm job growth is projected at 0.3% in 2026, following a projected 0.4% increase in 2025. The state's unemployment rate is forecast to rise to 5.8% in 2026 from a projected 5.6% in 2025 and 5.3% in 2024. While these unemployment levels remain within normal historical ranges, they reflect a labor market that is not generating the rapid job growth that characterized some previous periods. Inflation projections also factor into housing affordability considerations. The CAR forecast anticipates that the Consumer Price Index will average 3.0% in 2026, up slightly from a projected 2.8% in 2025. While inflation has moderated from peak levels reached in 2022, ongoing price pressures affect household budgets and purchasing power. Economic analyst Jordan Levine from CAR notes that as economic uncertainty begins to clear up in the next 12 months and mortgage rates start declining more consistently in the upcoming quarters, housing sentiment will see some improvement in 2026. However, Levine also identifies several challenges, including the ongoing trade tensions between the U.S. and its trading partners, the home insurance crisis, and a potential stock market bubble as factors that will remain challenges for the housing market in upcoming year. Housing supply dynamics also play a role in California's affordability challenges. According to sales data from ATTOM, California home sales averaged 27,000 monthly over the past year, compared with 33,583 in the previous 5 years. This 19% decline reflects the combination of affordability constraints and limited available inventory. On the construction side, residential building permit filings totaled 9,100 in the past year, representing an 8% decrease from the 10,650 annual average over the previous 5 years. This slowdown in new construction means that housing supply is not expanding at rates that would significantly ease affordability pressures. The CAR forecast does anticipate some improvement in housing supply for 2026, with active listings expected to increase nearly 10% as market conditions stabilize. This would bring inventory levels closer to pre-pandemic norms, potentially providing more options for buyers. However, housing experts note that California faces long-standing structural challenges related to housing supply. Geographic constraints, local zoning regulations, and development costs all contribute to limiting the pace at which new housing can be added to the market. California legislators have passed multiple housing-related laws in recent years attempting to address affordability challenges. According to recent reporting from KQED, 2025 was described as a landmark year for housing legislation, with bills targeting various aspects of the housing development process. Some legislation focuses on streamlining approval processes for housing construction. Other measures aim to provide tenant protections and rental assistance. According to housing policy analysts, these efforts represent a shift in how California addresses its housing crisis, though the impact of policy changes typically takes years to materialize in market conditions. Zach Murray of the Alliance of Californians for Community Empowerment notes that this is an important tangible step the legislature can take to actually address affordability for renters across California, referring to proposed legislation that would expand rent stabilization measures. However, property owner representatives express concerns about additional regulations. Adam Pierce, president of the California Rental Housing Association, indicated that while he's excited to see whether the laws impacting new housing construction result in more supply, there are concerns about how regulations affect small landlords and development economics. Looking ahead, the CAR forecast projects that existing single-family home sales will total 274,400 units in 2026. Representing a 2% increase from 2025's projected pace of 269,000 sales. This modest growth suggests a housing market that is stabilizing rather than experiencing dramatic shifts in either direction. The fundamental affordability challenge, with only 18% of California households able to purchase a median-priced home, represents a long-term structural issue that extends beyond short-term market fluctuations. Housing economists suggest that addressing this challenge will require sustained efforts on multiple fronts, including increasing supply, supporting income growth, and potentially implementing targeted assistance programs for first-time buyers and lower-income households. Claude is AI and can make mistakes. Please double-check responses.